Hello and welcome to the Mutual Fund Show. I'm Neeraj Shah. Over the next 20 minutes, we'll talk about the 2 or 3 aspects of mutual funds which we put out on our social line. Now, let me try and be a personal finance expert and give you an insight that you may or may not have known. And then our guests will correct me, of course, but let me still make an attempt. If you open a neo-banking account in certain formats, then you can get interest on that account up to, or rather, to the tune of 7%, pre-tax, of course, but 7%. So last show, viewers, you remember, I asked our guests that if a neo-banking account is giving me interest of 7%, and if the Reserve Bank of India guarantees a sum of up to 5 lakh rupees, should the bank go kaput, then why should anybody not choose that option? Hitherto, for the last 5 years, we've asked all our experts that why should people keep the money in banks and fixed deposits, and why not keep it in mutual funds? Because fixed income mutual funds and options there give better returns. Today, we are going to do the contrary or the opposite, which is going to ask both our experts today about why should not people choose a neo-banking option, which gives a 7% rate of interest, and Reserve Bank, if it's guaranteeing about 5 lakh rupees, then that money is not under loss. Of course, we'll discuss a couple of other things as well, but let me start off with this topic with Mr. Juzer Gabajiwala, is director at Ventura Securities, and Mr. Harshad Chetanwala, co-founder of mywealthgrowth.com. Gentlemen, both of you, thanks for joining in. Juzer, can I start off with you? Why should not a person put up to 5 lakh rupees in a neo-banking account, which gives him 7% or gives her 7%?
So first of all, thanks, Neeraj, for having me on the show. And yeah, it's a very interesting question. But neo banks is basically neo-gen, right? So you're basically talking about the neo generation. And so truly, this is not a bank in the true sense. So it's not that where you would say that it is a full-fledged bank, because under it also is a bank. So ultimately, they have to rely on a bank to have that. So and specifically, if you are going to be having and it's only on the savings bank where they are giving you a 7%. So yes, in all likely, from a commercial sense, it definitely makes sense for somebody to park his funds out there. But my question to you would also be is that I don't know that I have seen any investor put even 5 lakhs of rupees and say that he's kept it over there for a year in a neo bank account and just let it remain over there. Right? It means you would find people who would be doing that small sums of money, because at the back of the mind it is still there that it is still not a bank. Right? So and people will always have a tendency to compare it to a mutual fund return currently, and with current interest rates which are moving up, so none of the fixed income mutual funds will give you a return which will match up to any even 4.5% is a big challenge, right? Because it's purely due to market. So till the time interest rates are going up, this will be a fantastic argument. When you will have interest rates going down, we will start talking that why should people not put money in mutual fund, and why put money in a savings account. But today, for a mutual fund, also in a liquid fund, it's a challenge to even get 4%.
Yeah, precisely. So Harshad, that's the question, right? And again, let's assume that this investor who's listening to our show right now, she's got a time horizon of 1 year. I'm asking you, simply put, that what is a mutual fund alternative for a sum of up to 5 lakh rupees, by the way, because I'm saying that's guaranteed. Even if you argue that what if the bank goes kaput, the RBI is guaranteeing up to 5 lakh rupees, right? So for a sum of up to 5 lakh rupees, if this lady wants to invest those 5 lakh rupees, what is the mutual fund alternative to this 7% rate of return? Is there one?
Sure. So Neeraj, I think it's a very valid question in present time, because we all are aware that the fixed income mutual funds are offering much more lower returns because of the overall interest rate environment. So there is no doubt that in present environment, these neo banks which are offering, let's say up to the deposit of 1 lakh around 3.5%, and up to the deposit of 5 lakhs, between 1 to 5 lakhs around 6%. No doubt, most of the debt funds, in fact, all the debt funds or fixed income funds will underperform this number that we are talking about as 6% in present scenario. Okay. And as Juzer was saying that the interest rate scenario will soon going to change, where we do expect the interest rates to increase. So till the time the interest rates are on the lower side, which are there from last 2 years, because of course the RBI would like to support the revival of the economy. Till that time, we will continue to see neo banks, and the returns that are given by neo banks are good compared to debt. Okay. So just to simply answer your question that what this lady should do, of course, this lady do have an option to keep that money in that neo bank for time being, because it's offering 6%, which is not being offered by any other alternative at present. Okay. And neo banks are predominantly these fintechs who are also tied up with the banks in the backend. Okay. So from of course, and their money is secured till 5 lakhs, and that's what RBI is backing with. Okay. But the most important point, Neeraj, is that as the interest rate in scenario will start changing, you will see that there are better alternatives than this neo banks interest rate. Now, if we go back to history and let's leave out 2021, we look at last 4 or 5 years, and there are a few categories which have more better opportunity to generate returns than just this 6%. Okay. And typically, anyone who has a horizon of 1 year or 1.5 or 2 years predominantly uses debt and fixed income funds. So there are categories like dynamic bond funds, corporate bond, and banking and PSU. If you pull out any of these categories and see the returns generated by these funds, not on a CAGR basis, but on a calendar year basis, because that is what the time horizon of investors are typically in fixed income.
Sure.
Most of the funds would be above 6%, those who are doing well. So right now, no doubt, the interest rate offered by neo banks is good, and investors should take benefit of it. But having said that, as the interest rate scenario changes, there are better alternatives that mutual funds can offer, okay, with more stability and better way to manage that money, because you have a fund manager looking in the overall debt portfolio.
Now, viewers, this is I'm so happy that both our experts who advise mutual funds to their clients as well, presumably, are actually being candid about this, that, hey, if you have a 1 year horizon, sure, for now, the neo-banking option and a 7% rate of return option is a great option. Now, if you have a time horizon of up to 1 year, I just want to quickly go across before we wrap up this point and also ask both that what if the person has a time horizon of over 3 years, in which case the benefits of indexation come into play as well. And Juzer, does the math change quite a bit, or would you believe that with an assumption that this bank might be able to give a good rate of return until things change? Otherwise, who's to predict the future? But as things stand, the benefit of indexation, does that blunt the advantage that a 7% savings account option has over any mutual fund product?
Yeah, so actually, so let us understand the taxation play out here. So let us assume that if somebody is getting the saving bank interest of 7%, let's not get into the 10,000 deduction. It's a nominal amount, right?
Yeah.
Okay, so you would be, and if you're under a 30% tax bracket, so you would be paying 2.1% as tax. Okay, 30% of 7%, right? So your post-tax would be somewhere around 5.9, right? 4.9, right? So you are going to get a 4.9% return. Now, the benefit of indexation. So I'm now doing, more as thumb rule calculation. If you will actually historically look, so the indexation is roughly around 5%. Which the inflation keeps on going on every year. Okay, so over a 3 year, you get a 15% indexation. When you will translate it, it will mota it will work out to somewhere around 5 to 6% as effective, differentiation in terms of the taxation rate is what you get. So you assume that your tax rate would be around 5 to 6% because on indexation you pay 20%. Previously, when inflation was low at 4%, we used to take 10% as the thumb rule to do a back of the envelope calculation as the effective tax rate. To do an effective tax rate calculation. So here with a 5%, I would assume around 6 to 7% is the effective tax rate, considering the benefit of indexation, right? So if you are going to get, let us say, a 6% return on any debt instrument over a period of 3 years, I presume you could get up to 6.5 as of now. In any of the GSEC type of an instrument you hold for 3 years, you could get around 6.5. On 6.5, we would pay around 5% to 7% tax. Right? So your post-tax would still be higher than 4.9. So the math would make a person switch instead of being into a 7% instrument to because of the taxation. It would be better off for him to move into a debt fund and take the benefit of indexation.
Okay, what kind of debt funds at the current juncture, Juzer? Somebody wants to put in money right now. What are the best categories of debt fund that should be used? And Harshad, then I'll come to you.
So you can actually, I think the gilt is the one which would offer those type of returns. Then there are now some of these target maturity index funds which are there with a 3 to 5 year horizon. Those are the places where you would get this type of a yield. Specifically where right now you have a scenario where interest rates could rise. That's why, all the corporate bond funds or, your credit risk and all are going to get, adversely impacted. So the important thing is that the person will need to, ride out the volatility in the interest rate for the next, maybe you will see 6 months to a year, we could see a 0.5% increase in the interest rates. And this has a negative impact on all mutual funds. So in the short term, they would have to go through that pain, but then they have to wait it out for 3 years. And I'm assuming that the person has a 3 year plus time horizon to take the benefit of the indexation.
Harshad, what is your view and what is your math? It could be slightly different as well, by the way.
Sure. So Neeraj, there are two aspects that typically is going in my mind when I'm trying to answer this question for 3 years time horizon. So one is, most of the time people do not keep money in the savings account for 3 years. They would like to either deploy it in debt or, any debt instrument or a blend of equity and debt. One. We'll stick to the topic about savings account and debt mutual funds. Okay. So while taxation is very well explained by Juzer, in his talk, the second element is the duration. Right? When you're right now considering the interest rate scenario, where we all expect the interest rates to go up, okay, and this has been the stand for almost last one and a half to 2 years, that it is better to remain on the shorter maturity of the debt instrument. Because as Juzer said, as the interest rates will start increasing, there will be an impact on the overall portfolio of debt funds. Okay. So even though today I have a horizon of 3 years and I want to invest in fixed income, I would like to continue to remain in shorter duration, could be short duration or a ultra short duration funds, because I know very well that within 3 or 4 months there will be a increase in interest rate. And as and when the interest rate starts increasing, it is the right time to start chipping into the debt side.
Okay, and what are the options that, let's assume that the person doesn't have the luxury to wait for the right time and wants to invest the money today. Juzer recommended gilt funds. What is the option that you would give to somebody with a 3 year horizon and not a 1 year horizon?
Sure. So, I would continue to be on the, as I said, I would continue to be on the shorter side, maybe short-term, short duration funds at present. Okay. Mm-hmm. Let's say if in case you do not want to time the market, okay.
Yes.
And that is where, that's where probably I'll be comfortable with dynamic bond fund or a banking and PSU fund. But there's one thing that I will definitely look at, Neeraj, or all those investors who are planning to do it should look at, is the maturity of the overall portfolio. The shorter the maturity of these funds, that is corporate bonds and banking and PSU and dynamic bond fund, the more safer you are from that volatility. Okay. And then, of course, you can ride along when the interest rate changes with these funds.
Got it. So viewers, keep that in mind. And I hope you got some advice. Remember, the show is not a complete solution for all your needs, but here we try to get you the best possible advice, at least from the people who kind of understand the subject very well. So gentlemen, both of you, thank you for this. A lot of people would be pondering with this question, and therefore your advice would be very helpful. For me as well, by the way. Let's talk about a couple of other things. And Harshad, this one I'll start with you. Low volatility factor funds. A lot of people have been seen as recommending them. Are these good? And if they are good, for what kind of investors are these good?
Sure. So I think we all understand what we mean by low volatility fund, where
you can choose to take a minute and explain, Harshad.
Sure, definitely. Thanks. Okay, so basically, these low volatility funds are basically a blend of active and passive fund investments. Okay, where the investments will happen. Let's say the universe is defined as Nifty 100, and within this Nifty 100, there are 30 stocks which will be picked, where the volatility is much more lesser, or it starts with the lowest volatile stock, and that will have your top holding. As the name suggests, these funds are meant for those investors who do not want to, who are probably looking at more stable companies to invest into, being on the equity side. What kind of investors should be investing into it? I think those investors who want, as I said, stable companies to park their money. Okay. One thing we have to keep in mind that these funds can play a role when on the downside. Okay. So the downside could be much more lesser compared to an equity diversified fund when the markets are not in favor, okay. And vice versa, when the markets are doing well, okay, you will see that these funds will probably underperform the actively as well as equity diversified funds. Okay. So this is one thing that one need to keep in mind. So risk averse investors who have who would like to park some part of their money in this kind of a portfolio can consider into it. There's one more important point, Neeraj, I would like to highlight, okay, and this is very important from an investor's perspective, because I think these low volatility funds have a shorter history right now. I think 3 to 4 years. If you try to put it in a 4-year horizon, there have been 2 years like 2018 and 2020 which have been volatile, and during these times, these low volatility funds have done better. And if we see a horizon of, let's say, 2019 and 2021, that is where your diversified equity funds have done better. So a lot depends on the risk appetite and what does the investor is looking for. Of course, the portfolio also changes drastically, because most of the equity diversified fund will have, let's say, financial services across the category as the most preferred sector, which is very different than low volatility, where FMCG or consumer staples is like top sector. So a lot depends on the investor's profile, and those investors who would like to take investments or do investments in a much more stable companies can consider investing into low volatility.
Juzer, are you guys recommending, or are you personally recommending low volatility factor funds?
No.
Why or why not?
So I think Harshad has explained the concept quite well. So at least I don't have to explain the concept in that sense. So in fact, I think people need to be very clear that are they confusing risk with volatility? So the investors need to be clear that if you are coming to equity, equity market is going to be volatile. If you expect that equity is not going to be volatile, then you are in the wrong market. So for me, I don't. It's like we used to also have something called as dividend yield funds. So for me, this is like you can say old wine in a new bottle. Okay, so I don't think that this is a right. We have seen very clearly that if you are, I think there are enough illustrations we have seen around that if you are 1 year, the volatility is at the highest. As you keep on progressing, 2 years, 3 years, 5 years, 7 years, 10 years, the volatility reduces drastically. So, I think it is the time of the investment is more important for an investor to be invested in, rather than trying to investor is coming to the equity market to make returns, and if he cannot digest volatility, the product is not for him, and he should not confuse this with risk, right? So it's like I'm sure we all have heard the stories of ITC, right? ITC has been a no volatile stock. So it didn't move at all for so many years, and you'll always find stocks which are going to be like that.
Yeah, the ITC memes are just so popular.
Yeah.
But Juzer, what's the kind of returns that people can get from a low volatility factor fund?
So I mean, if you see, if you look at it like that, I think the 3-year return has been somewhere around 13%. Okay, and that is also more or less tracking the Nifty 100. I mean, so it has more or less been the same. Now you would, the biggest disadvantage or advantage of any point-to-point return is that you can, look at it at whatever time you want, which is convenient to you. right? So you change the time horizon and you can get the result you want, right? So when I look at it today, it is 13% Nifty, and this both are same. You'll find that when markets are very volatile, you'll find that this fund has given better return than compared to the Nifty, and there'll be times when Nifty will give returns better than this particular fund. So you'll always keep on having different time horizons.
Okay.
So,
Okay. But since both of our guests, viewers are saying that they are not quite in the favor of low volatility factor funds, I'm not going to even ask them to make a recommendation because they don't believe that the product is really a good one to invest in the first place. So let's leave that out. Maybe we'll try and do that in a bit. Because I'm going to ask these guests to give us some key suggestions from an equity mutual fund investor's perspective. But before that, one quick question. It's a question that is never tailor-made, Juzer, for anybody. One size doesn't fit all. But if I still ask you to take an average, let's assume an average 30 to 40-year-old person earning average salary, wants average returns over an average time frame, what is the right number of mutual fund schemes that a person should have? Because since the time I've started this show, Juzer, I have seen numerous examples, and these examples don't go down, of people having innumerable number of mutual fund schemes in their portfolios. So therefore, I make it a point that in every financial year, I ask this question to my guests: what is the right number of schemes that a person should have? Is there a right number?
So I don't think that that there is a right number, because, like you said, that no solution fits each and every investor completely. Okay, so you will not have a foolproof answer to that. More important than the question of the number of schemes is, I think what one needs to also look at is that what is the overlap of the portfolios. I think that is something which is missed out. So it is more important to see that you don't land up with two schemes having, at least, which will have 70 to 80% of the portfolio is the same, right? So if it is going to have a same portfolio, then you are actually not in the, one of the scheme you really need to consider moving out. Right? So that is one parameter which a person should look at. That is there a overlap between the two schemes in the portfolio? The second is that, if I have to give a number, I'm sure that, max 10 to 12. I mean, if you want to go to a number of scheme, because ideally, I would want my client to hold a small cap fund. I would want him to hold even a mid cap fund, so that he has different baskets to, cater to. Then now you have got international as another flavor, so you could have region specific. Somebody would have a view on that. Then you have a person wants to hold gold as a investment, so gold becomes a thing. So at different points of time, a person is using even for different objectives, right? So for example, if somebody is looking at that I want to create a investment for a goal for my child's education, so maybe you would give him a more like a balanced fund, which is not very aggressive. So that would actually add one more scheme to his portfolio. Okay. If it is a retirement, you would, and the number of years are quite long enough, you would also give him small cap, mid cap, so that he has got enough alpha which he can build up over a period of time. Right? So, this is not something which will, fit, a complete solution. But yes, a person should try to minimize his number of schemes. But what we have seen with investors nowadays is that they, because of technology and everything is available, on their desktop and online, right? So then they don't bother whether they have got 10 schemes or 20 schemes, because everything is available to them through the system.
Sure. Understandable. But I'll still, Harshad, can I try with you? I'm still impressed upon this. Like I said, it will be different for different people. But if you look at the averages that I've lined up, is there a maximum number beyond which a person should ideally not go? Just let's approach this question this way. I mean, should people not have, for example, 20 schemes in their portfolio because it might be difficult to monitor or what have you?
Sure. So, Neeraj, is a very important question, and good that you take up at every financial year. Okay. We have seen portfolios which range from 50 to 60 funds. okay, which is absolutely not the right way to invest into mutual funds. Of course, there's overload of funds outside. There are more than 1,000 mutual funds and 400 equity funds. In our view, what you need max is around 8 to 10 funds. That's it. Okay. The key is align this 8 to 10 funds based on the financial objective and the time horizon. Like precisely how you started. Let's say I'm a 35-year-old person. I'm investing for my average duration is X, and my average duration is X, and I need Y money. That's it. That should be the starting point. On that basis, we start. You start building the mutual fund portfolio. Now, the key is, of course, the overlapping of the portfolio, which Juzer did touch base on, and which is right. Okay. But having said that, when you're trying to build a portfolio across equities and debt, along with overlap, one need to look at what's the blend of market capitalization. So at the portfolio level, it's important to look at market capitalization. How much of my percentage is into giant caps and large caps, and then small and mid caps. Ideal way to build the mutual fund portfolio across, of course, around, let's say, 8 to 10, can be through index fund and large cap and large and mid cap and flexi cap. If you look at the universe, of course, you could be higher on the large cap side, but that's the right approach to begin with. There's no need for anyone to straight away start with 8 to 10 funds if in case you are starting your journey. You start with 3, 4, 5 funds and then bring it to 8 to 10 funds as you start working on your financial objectives.
Got it.
And even in debt, like this is equity on the debt side, depending on your investment horizon, one has to look at the maturity of the fund. There are massive mismatch that we have seen. If I need that money in 6 months and I tend to go in a gilt fund or a long duration fund, I'm taking more.
Yeah.
So on debt, it is more important to look at the maturity of the fund and your investment time horizon. And you don't need multiple portfolios. In our view, 8 to 10 is good enough.
Got it. Okay, gentlemen, before we wrap up the show, Harshad, last question to you and then last question to Juzer. For somebody who's looking at equity, for an equity mutual fund investor, any advice on any good funds that you guys may have come up with recently in your research that you may have advised to clients, keeping in mind all that's happening around volatility, etc., etc.?
You want me to pick it up?
Yeah, Harshad, let's start with you. Yes.
Sure. Thanks. Okay. So no particular fund, but I can tell you that you can consider looking at large and mid cap and flexi cap category. There are very good funds available in that horizon today. The key is considering the market environment. It is important to go in a gradual manner rather than doing all at one time. Okay.
Harshad, but I would urge you to, if not give one recommendation, maybe give a list of 2 or 3 names so that people have some actionable information, because otherwise people will be left grappling. They would know that, okay, flexi cap funds are great to invest in, but they wouldn't know where to fish. So you can give maybe a list of 3 or 4 names, and these will not be the overall list that you have, but they can at least look at some of these.
Sure. So at our end, we continue to say that if in case anyone is looking to invest in a large cap fund, we are putting forward, let's say, Canara Robeco Blue Chip or a Mirai large cap. In a large and mid cap, of course, Mirai Emerging Blue Chip is not accepting lump sum. So there goes your Canara Emerging Equities and your Kotak Equity Opportunities Fund. On a flexi cap, it is Parag Parikh Flexi Cap, followed by UTI Flexi Cap. These are some of the funds that we are putting forward from an overall allocation perspective. The key is to limit the allocation towards each of these funds. And in our view, we are saying that limit it to around 15% and keep it more diversified. And that is where the number of 6 to 8 or 10 funds goes on an overall portfolio construction perspective. Coming back to the point before the recommendation, looking at the market environment today, it's very important not to put all the investable surplus in one go. That you can go gradual. That's a better approach, because we do believe that markets could go through some pain in the near future, and that could also give you an opportunity. It's very difficult to catch the bottom, but try to invest gradually as and when you see. Like last 2 days have been very good, where markets have been almost, barring today, markets have been almost down by 4%. And if we see from last 8 days, except today, markets down by 8% or so. So these are the opportunities where people can, investors can chip in and start investing 10-15% on these falls, and then over a period of time build it. The key is not to take knee-jerk reaction, stay the course and continue to invest.
Sure. Juzer, same question to you before we wrap up.
Yeah, so I think most of the schemes have been named by Harshad. So I think, I also go by that. I think he has only missed out a few in the small cap space. So I think one can even look at Nippon small cap, and Quant small cap has also been doing pretty well. So it is more for people who would like to have a momentum type of play also. So some allocation can be considered out there. The other thing is that the important thing is going to be is that we should not expect the same returns which we have expected in the last 2 years to continue. I think today the expectation of everybody is that we are going to be having the same sort of a journey. Okay, so that is not going to happen. And when I tell my investors that don't expect the same returns, the next question they ask is that should I get out? So my answer to them is that please do not try to time the market, because I'm only telling you not to expect, but I don't know what is going to happen, right? So do not try to time the market also. Stay focused on what you are doing. People are getting very jittery because markets are volatile, right? But markets will always be volatile. Whether you will talk about Ukraine, Russia, tomorrow we'll have something else. Okay, we will just have talking points, right? So continue your SIPs, do not stop them. Stick to your asset allocation. People are getting very, very hyper in the market. And this is a time when everything goes hunky-dory. We tend to lose sight of our asset allocation and avoid leverage at all costs. So,
fair call. Gentlemen, on that note, thanks so much for joining us today on the Mutual Fund Show and giving us your thoughts. Appreciate your time.
Thank you, Neeraj. Thank you for having us.
Pleasure was ours. Viewers, thanks for tuning in.